Hey gang, this is Greg Barron. Thanks for joining us again on our YouTube channel. We got a ton to talk about today. We're going to try to distill for you. So some of the topics today are: Fed pauses the rate hike after 10 incremental increases. The market has continued to rise, so are we bullish right now? AI stocks are zooming right now. What does that tell us, and what can we expect? Unemployment is ticking up. Are we seeing a crack in the labor market? Inflation is trending down, but we've got a ways to go yet. Housing inventory and sales are still struggling. And what's going on in this fragile commercial real estate environment, and what can we expect the rest of the year? And then we'll pop into the question, do you think a recession is still coming? So first of all, let's talk about this pausing of the rate hike by the Feds. Does this mean that they're pivoting right now? But before we do that, let me read to you this recent article by Axios Matters, a great publication that I get, and it says, "Why it matters. The last 15 months saw the sharpest series of rate hikes in 40 years, radically reshaping markets and the economy. Now it might be the beginning of the end of that era." And I would add, or is it? So here's a few ways the tighter money has rippled into our system in a very short time. And remember, this is the fastest velocity of rate hikes that we've ever experienced in 40 years. So number one, the raising rates hammered the stock market in 2022, sending the S&P 500 down a total of 20%, its worst year since 2008. Number two, highly speculative, tech-centric growth companies, especially sensitive to interest rates, were clobbered with the NASDAQ composite tumbling 33%. Mortgage rates soared from roughly 3% at the beginning of 2022 to more than 7% at times in this last year, drastically reducing affordability and slamming the brakes on home sales activity. Something that you don't hear a lot about, corporate borrowing costs skyrocketed, cutting off access to capital for riskier companies. Deposit rates rose sharply for savers. My grandparents would enjoy this. And some banks like the Silicon Valley Bank found their deposit base was far flightier than they thought, just as the rising rates crushed the value of their bond investments, hence the reason that they have failed. So the question that I have is, what's next? Do we really have any prognostication out there that tells us, is the Fed going to pivot, or are they going to let it just remain for a while? But let's let Jerome Powell tell us. He says in this next sentence, "It may make sense for rates to move higher," he says, "but a more moderate pace." Chairman Powell also indicates in announcing his decision not to lift rates for an 11th consecutive meeting that the Fed's rate-setting committee hastened to say it could return to rate hikes if inflation doesn't continue to drop. That's kind of like telling your kids, if you don't do something, I'm going to do something to you. So he's basically warning the economy, stop spending money so we can get inflation under control, so that I can get my 2% inflation back in order. And I'm not going to raise the rates anymore. And I might lower them. My next question was, are we in a bull market? And what's going on with the AI stocks that seem to be zooming right now? Let me read to you again from Axios in a different article, which gives a little more clarity as to why maybe this bullish market is happening and what in the world do the AI stocks have to do with it. And I think you'll see some correlation in the bullish nature of the stock market as it relates to the AIA stocks that are pushing it through. So again, let me read to you from Axios. The stock market continues to gather steady momentum, with the S&P 500 notching the strongest of 6 straight gains on this last Thursday and climbing to another new high for the year. It's up 15.3% in 2023, less than 8% from hitting a new high. However, let's read between the lines. The only reason stocks are in such good shape is because of the performance of 7 massive tech titans that are responsible for almost all of the market's increase this year. Now, grasp what they're saying there. Yes, it appears as if we're in a temporary bullish market, but it's really only controlled by a handful of stocks, of which Axios calls the Magnificent Seven. And these 7 stocks we need to pay close attention to because they are driving the full momentum at this point of the surge of the S&P 500. These stocks include Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta. Combined, they're up nearly 90% this year in a rally fueled by excitement about their exposure to AI. So remember, this alignment to AI is pushing this Magnificent Seven. But back in the 60s and 70s, back in the days when I was growing up, they called it the Nifty 50. And some of those stocks back in those days that experienced this surge and bubble were Sears, Eastman Kodak, Polaroid. Now, I'm not saying there's weaknesses in any of these stocks. Well, I guess at 40 times sales, I would say that I wouldn't be a candidate to purchase at this point. But if you're an investor, you have to recognize not to jump on the euphoria of the S&P when only 7 stocks are really pushing the surge in what we're calling the bull market right here in the first quarter and the interest to the second quarter of 2023. In the latest graphs that you can see, unemployment is on the rise. Now, if you go back to my last video, I spelled out an acronym, HOPE, which basically is a predictor for coming potential recessions. It starts with housing. It moves to orders because orders are reduced when housing reduces. And then it goes to corporate profits. Profits start to stagnate or decline because, frankly, there's no need for the orders to produce profits. And the last flag to turn red in all these indicators is unemployment. I said in the last video, watch for unemployment to start to rise. That's the final indicator that a looming recession might be on the horizon, and this is what we're seeing right now. Speaking of recession, one of the charts that I continue to watch on a monthly basis is the NFIB Small Business Optimism Index. Instead of looking at indices for large and small cap stocks and the market in general, the NFIB puts out this Small Business Optimism Index, Small Business Production Index, several indexes that are businesses that don't trade on the market, and it tracks them on a monthly basis. As the survey implies that I'm showing now on the screen, it often displays a lack of internal consistency because the NFIB is dominated by very small businesses. And as a result, certain sections of the report closely resemble consumer sentiment measures rather than traditional business indicators. What that means is this is small-town America right now telling us how they feel. And as you can see from the chart, starting with the peak of 2018, this particular optimism index continues to plunge to today. Well, quite frankly, what it's telling us is that small businesses as a whole since 2018 have continued to be less optimistic about the future business environment that they're operating in. And today, it's the lowest it's been since prior to 2016. Before we get into commercial real estate, let me speak just a little bit to residential housing inventory and sales. Actually, housing sales have bumped up a little bit. However, since their peak, they continue to be 50% lower than they were this time last year. They're still on a continued downward trajectory. We've seen a bump in home sales recently because mortgage rates have inched down. The question, I guess, that's out there right now, 2 things. Housing inventory, as you can see, is still at a low level. There is still an undersupply of homes to meet the needs for those that need the product. However, rates have doubled, so people aren't jumping wholeheartedly back into the market yet. But make no mistake, there is still an undersupply of homes needed for the market demand in the future. The big question I have, and a lot of people have, is what is going to establish a new normal, and when is that trigger going to take place, and what rate is it going to take for people to come back into the market and start purchasing homes. Speaking of purchasing homes, as you can see by the chart, mortgage applications are still lower than they were in 2014. What a difficult time it is to be a mortgage broker in this economy. My heart goes out to my friends that are in that business. It's a real struggle right now. And lastly, a couple of comments on the commercial real estate market. Not to add fuel to the fire, but let's just look at a graph for the demand for CRE loans. The demand for CRE loans has plunged 80% year over year. This comes as no secret as we continue to witness the weakness of the work-from-home environment and the incremental rate increase structure, which has basically doubled interest rates in this reset environment. A couple of things, though, that I want to point out as a real estate developer, investor, former banker, all this hubbub about the community and regional banks and the fear that kind of goes along with it. I've had a dozen phone calls from regional and community bankers in the last month. I asked them a couple of questions, and basically I wanted to know how your portfolio is doing, how are you faring, and what do you see on the horizon. Interestingly enough, most regional and community banks, one thing you have to remember is their loans aren't as broad as the big banks. They're not the $50 to $100 million loans that you hear about walking away from the commercial deal. Most of their loans are in the $1 to $10 million range, which make up the diversity of their portfolio. And the key element to that is most of them have personal guarantees on those loans. Most people, including myself, are way less apt to walk away from a commercial real estate deal than we would if we didn't have any personal guarantee. Most have indicated to me it's going to be a bumpy road in 23 and the first and second quarters potentially in 24, but their balance sheets are in good shape. There will be some of those that need to be modified and restructured. There may be some of those that they're going to have to give back. But primarily, the market tends to concentrate on the bad news coming from San Francisco and New York, where you've got this walk-away mentality, where you have the flight from the cities and some other political problems that they have. But as far as I see, regional and community banks, they're going to weather the storm. There's going to be some opportunity, but there's not going to be a wholesale destruction of wealth and the whole economic environment because of the commercial real estate issues that are currently ongoing. Just a reminder to hit the like and subscribe button if you would, to keep us going on this channel. It takes a lot of research just to come up with this short stuff that we do. We love to hear from you also in the comments section. Any questions you have on anything that I've indicated today, or pose a question to me and I'll try to get back with you. Lastly, let me close out by giving you my opinion on whether we're going to be in a recession. I still think we are. However, a recession is not an event. A recession is a process. It will be a slow grinding. Whether it's going to be a soft or hard landing is yet to be foretold. But all indicators, the one that I use, housing, orders, profits, unemployment, are still indicating that we'll probably move into a recession the third to the fourth quarter of this year. Get your households ready. Keep your powder dry. Be kind to someone today, and we'll see you next time. And I think you'll see some correlation in the bullish nature as it and I think you'll see some correlation as to the bullish nation. And I think you'll see some correlation into the bullish nature. And I think you'll see some bullish We done it. We done it. The bull market's on.